In this video, you'll learn how to trade the flag pattern. Specifically, you'll learn what is the flag pattern and how does it work. When is the best time to trade a flag pattern? Because not all flag patterns are created equal. I want to share with you the two best times that you should be looking for it. You want to trade this pattern. And then how to trade the flag pattern, a simple trading strategy that you can use to trade. Hey there, I'm Paul and I'm involved in trading. I started this YouTube channel to share my knowledge and create a lasting impression. I've been in the trading world for quite a while and I have plenty of the technical samples and hidden games to offer. Be sure to subscribe to my channel so you won't miss out of any of these valuable secrets. Let's get started. What is the flag pattern? I define the flag pattern using two criteria. Firstly, a strong trading move, usually shown by large body candles. Secondly, followed by a weak pullback, usually shown by small body candles. You can see here there is a strong trading move followed by a weak pullback. This is what I consider a bullish flag pattern. Small body candles and a very weak pullback. And the bearish flag is just the opposite. Strong trading move lower and a weak pullback. Different types of flags you should keep an eye out for. There are many different types of flags that technical traders should keep an eye out of when analyzing chart patterns. High and high flags. A bullish flag pattern that occurs when a stock experiences a sharp price rise, followed by a brief consolidation period. Bull flags are bullish continuation patterns that force when a stock is on uptrend and experiences a brief consolidations before continuation is upward trajectory. Bear flags. A bearish continuation pattern that forces when a stock is on a downtrend and experiences a brief consolidation before continuing in its downtrend trajectory. Pennant flags, a bullish or bearish continuation pattern that is similar to the pennant pattern. The only difference is that the flagpole is not a thread of the pattern forms a small rectangle. So, wedge flags, a bullish or bearish continuation pattern that forms when the price consolidates with an reverse-shaped pattern. When is the best time to trade flag pattern? In my opinion, there are two times which I found favorable to be trading these patterns. When the market just had a breakout and let's say the market is in a range, and then finally is brought down. When it breaks down, the best time that you want to trade the flag pattern is one of the first pullback. When you see a bearish flag pattern that is forming, that is the best time to trade the flag pattern. Why is that? It's because the traders who miss the move will be waiting for a pullback. You can be sure that when market pulls back when the flag pattern is being formed, there are traders looking to short this market and misses the early move. So they are trying to catch the trends. This is why I personally like to trade the first pullback on the first flag pattern when the market should just had a breakout. Strong trading market is a strong trading move market. You have a trading move and you have the pullback trading move or pullback. It's usually when the market is trading strongly, trading about the 20-period moving average. There are all possible opportunities to trade to a pullback in the form of a flag pattern. How to trade the flag pattern? First and foremost, let's talk about the long side of things. Interest. So, bring about the high. You can wait for a candle to close or you can go along with a buy stop order. There's really no better approach. Whichever approach you're more comfortable with, stick with it. Stop loss. 1 ATR below the low of the flag. I typically set my stop loss on 1 ATR below the low of the flag to give it some buffer, so that I don't get stopped up previously. Moving average to trail your stop loss or use the structure of the market. For flag patterns, I would suggest that you try to ride the event, because flag patterns typically occur just after a breakout or in a strong trading market. For me, I like to trail my stops but rather move as such as possible when I trade the flag pattern. This means that I don't have fixed for target profits or whatever. Let's say the one ATR is $10 and let's say the water is somewhere like $200. So $200, $10, your stop loss will be like $190. Alright, simple. And then your excess you can either use a moving average to trail your stop loss, or as the market makes higher highs and higher lows, you can just trail it using the previous low. So let's now observe the flag pattern in action on an actual chart. While pattern provides a solid foundation, practical demonstration adds substantial clarity. Recently, the USD and Japanese yen currency pair exhibits a robust downward impulse. Building upon this impulse, I'm proudly entering a trade for 5 minutes with a stake on the $1,000. Feeding this opportunity without delay is crucial. The situation is already unfolding, prompting my entry. Let's delve into the dynamics at play here. Firstly, understanding a channel is discernible. Secondly, presenting this channel, their existing counter impulse. This represents a notably poignant downward impulse, causing a substantial price decline. Subsequently, a correction transpired, culminating in the formation on the pattern under tiny bearish flag to be breached. Subsequently, the steps adhere to certain logic. The price is presently breaching the correction in a downward direction. This adds an initial downward impulse followed by a downward breaking correction. The next step entails a waiting movement equivalent to our initial impulse. An ideal scenario materialized on the chart since the distance from the initial impulse to the correction approximates that span from the correction to the support zone. I executed the trade just after the flag pattern's breakout. Crucial emphasis must be placed on entering such trades exclusively after the flag breakout has commenced. In cases where the breakout hasn't yet initiated and the price remains within the channel, entering the trade is unadvisable. Moreover, specific scenario may necessitate waiting for a minor update. Observing the present price level, at time is prudent to wait until the price descends to the lower point where the correction originated. This mirror update constitutes optimal confirmation on the flag pattern's initiation. Flags have exhibited consistent efficacy, particularly over the past half year, or flags and ranges, being classic chart patterns essentially underpin the original technical analysis. Their consistent effectiveness has ensured their enduring relevance. To sum up, this trade is both straightforward and gratifying. Oh, I excited that the trade for 5 minutes instead of the customary 3. I loved this additional time to avoid loss inducing closure in the event of the correction induced by my random market movements. Now, let's wait its closure. Having allocated some extra time, the trade is poised to conclude profitable, successfully validating the flag pattern. A flag can be used as an entry pattern for the continuation of an established trend. The formation usually occurs after a strong trailing move that can contain gaps. This move is known as the most or pole of the flag, where the flag represents a relatively short period of indecision. The pattern usually forms at the midpoint of a full swing and consolidates the prior move. Price is connected by two parallel trend lines that lie close together and are slowed against the mast. Bullish flags can form after an uptrend. Bearish flags can form after a downtrend. The pattern has colored when the price breaks out of the containing trend lines in the direction of the prevailing trend. at which point it will likely continue its course. Constantly, traders may look for additional confirmation of the trend continuing. The target can be estimated through the technical or measuring that the length of the mass and extending in the direction of the breakout. A common stop level is just outside the flag, on the opposite side of the breakout. Summary up. A flag pattern is a weak pullback on existing trend, usually shown in the form of the small bodies candles. The best time to trade the flag pattern is after the breakout of during the strong trending market. And to trade the flag pattern, you can enter when the market breaks above the highs with the stop loss 180 or below the low. If you want to exit your winners, or maybe it may be a winning or losing trade, but if you do not trail your stops, you can consider using a moving average. And of course, or you can use the structure of the market. It is on an uptrend. You can trail it using the previous low to trail your stop loss. Thank you so much for your kind attention. I'm thrilled that you watched the video all the way through. If you liked this episode, please show your appreciation by giving us a thumbs up and leaving a positive comment. Feel free to share your trading experience, whether you're a seasoned trader or just starting out. Once again, thank you so much, and I look forward to seeing you again soon. Bye-bye.